Good morning everyone and welcome to this month's HUBsights webinar. My name is Karen Arthur and I work in the marketing team here at Hub24. Today we're joined by Christian Obrist, Head of iShares Australia, who will present ETF due diligence and selecting the right ETF. So without further ado, I'd like to hand over to Christian.
Great, thank you very much Karen, and I'm just going to grab the mouse here. So good morning everybody, and I'm very excited to talk to you about ETF due diligence, and while that may sound a little bit boring, I promise you it's going to be very useful for you. And really the idea behind it is that it's an educational framework for you to really think about, ETFs and give you a framework to think about the right ETF for your specific needs, because there are a lot of ETFs out there. In Australia, we now have close to 200 listed on the ASX. Globally, there's over 6,000 ETFs. So there's a lot of product out there, a little bit of a sea of products. A lot of them have different structures, different indices. So it's important that we have a framework to break that down and to really figure out what's right for you. So let's get straight into it. And I just wanted to kick off and give you a little bit of a picture of where the industry has come from, the growth that we currently see, and where we expect it to go. So, the first ETFs came to the market in 1990 in Canada, not the US, the first one. And we've had explosive growth in the last couple of years. 2017 was really a standout year. 2018, a little bit less so, but still the second highest year on record for net new flows. And when we look forward, our expectation is that, we're going from a $5 trillion industry, that is US dollars, to, anywhere between 9 and 12 over the next 5 years. So we still expect strong growth. And I'm going to tell you why we expect that growth. It's not just a trend that we think, but it's really founded in more structural reasons and not just cyclical. So we'll move to the next slide and just talk a little bit about these forces that are driving the ETF industry. And again, here you can see it on the slide. It's really structural, not cyclical. So on the left, you see, looks a little bit confusing, but what is that? You see unbundling of alpha and exposures. And the way you can think about that is what we're seeing happening at the moment in the market is that investors are really dividing product into high conviction alpha, where they really, want to pay a manager to gain excess return. And then markets where they don't believe that a lot of alpha is available, you can just choose an exposure. And by an exposure, I mean just beta. So US equities, for example, are a good example of an exposure. It's what we call the core funds. You can buy not just from BlackRock, from our competitors as well, S&P 500 for just a couple of basis points. So it's this unbundling of the alpha product, the high conviction, markets that are very complex and less liquid, and then also going down the track of just, making sure that you reduce your cost for exposures where you don't believe that alpha is possible. Next, we've had a shift to fee-based advisory in wealth markets, and that's really a global phenomenon. You see it in the US. You see it in Europe, in the UK, with the banning of retrocessions. You've had, Asia is still not quite there, but there's more transparency in the system. And of course, if we look at Australia, you had FOFA 5-6 years ago. We just had the Royal Commission report come out on Monday, also looking at, the removal of the grandfathered trailer fees. So we continue to see this, and as we see this growth in fee-based advice, advisors are typically starting to use ETFs or equivalent products as building blocks for their portfolios because they're low cost, they're transparent, and it's a very efficient tool, again, highlighting the low cost nature of the products to build a portfolio, retain your margin, and give your client a very flexible portfolio that they can adapt to the changing market needs. And then finally, what we call here demand for on-exchange transparency. We've seen this primarily in the fixed income markets. If you think of the equity markets, you've really had that revolution many years ago, where equities started to be traded on the exchange, very liquid. Everyone knows what a stock is, and it's just it's the common way we think about investing, and we know our single stocks, our Apples and Googles and etc. And in fixed income, it's still primarily an OTC market traded over the counter, less transparent, less liquid. Bank regulation has not really helped that too, when we had the GFC, so it got even more expensive for the banks to run inventory and trade these products. So we see a demand from the investors to have more transparency, better liquidity, and as a consequence, there's a need for that to shift to the exchange. It is more complex because if you think about the bond world, you have an issuer can have many different types of bonds with different maturities, different coupon profiles, etc. But we are moving into a more electronically traded environment, and the ETF ticks the box on that too. So structural change is here. When I think of perhaps as an analogy, the technology S-curve, which is the rate of adoption of a new technology, when we think of that S-curve, we used to think that ETFs were maybe coming to a slowdown, but actually we think that we're still at the very beginning of this take-up and adoption of the ETF into portfolios. And on my next slide, actually I'll just jump one to make the point. Here, you see that the penetration of ETFs as a percentage of overall assets is still quite low. This chart reflects the US equity market, and on the left in blue, and on the right you see the fixed income market, and you can see US equity ETFs 8.7% of total equities in the US, and in the fixed income space it's 1.1%. Now, globally speaking, it's more like 3 to 4% on the equity side, and less than 1% in fixed income. So a lot of runway for growth still. And I'll just jump back one slide again. The growing versatility of ETFs. So we heard the structural reasons, but also, there's also very practical reasons why people buy them. And, I didn't want to go into the basics here today, which is really transparency. In a physical ETF, you can typically go to the website and you see all the holdings. The costs are very low. Again, you have a lot of price compression going on in the industry. You've got great diversification. You just do one trade, you get exposure to hundreds or thousands of bonds or equities. Liquidity is another very important factor of ETFs. But here, what I really wanted to say is that for us, one of the biggest groups of investors that has been driving that adoption has been alpha managers, and the ability through the growth of ETFs, the number of products that are on the market, and the ability to go and deep dive into very specific areas of the market gives you that ability to seek alpha. So that's number one. Number two, because you have that breadth of product, whether it's equities, high yield, investment grade, government bonds, short duration, or even cash ETFs, you're able to manage your risk now because, again, you have that breadth of product. Sustainability is a big topic. You've got more products coming to the market, and we can talk about that a little bit later. And finally, tapping liquidity. Liquidity is such an important factor for people. Getting into a product is one thing, but getting out is another thing, very important. The ETFs, and we'll talk about it a little bit later as well, you're basically taking a index mutual fund and putting it on the exchange. So you take on additional layers of liquidity. So you basically have two layers. You have the exchange liquidity, and when that runs out, when there's no one on the other side of the trade, you can just increase the size of the fund. It's a very automated process, and you just the brokers in the market can just add more liquidity. So the real bottom line is that you just need to know what you own, and the underlying liquidity is what's key. So if it's a small ETF, doesn't matter. If it's linked to, let's say, ASX 200, well, it's a liquid underlying. Okay, so we'll continue along. So let's get to the heart of the presentation, ETF due diligence checklist. We'll just start with an overview. We've got 5 things here. The manager, just make sure that you know who the manager is, what do they stand for, and what kind of products do they manufacture. Exposure, understand what you're buying into. The structure, typically divided as physical ETFs or synthetic. Liquidity, again, you know, what's my ability to get in and out and at what price. And finally, the costs. Should I only be looking at the management fee, or are there other elements? And there's definitely a lot of other elements, so we're going to talk about that. So the manager, I think there are many ETF managers out there, and understanding an ETF comes down also to, you know, the manager's ability to track their index. So you may think, well, if it's an equity benchmark, that's quite an easy thing to do. I'll just buy those 200 ASX stocks. And for equities, plain vanilla equities, that's definitely the case. Once we start going to less liquid markets, the manager's capabilities become incredibly important. We will start optimizing the funds, meaning we don't buy all of the bonds necessarily. So that portfolio management capability, risk management capability becomes extremely important. So what we're looking at here is 2 things: tracking difference, which is the difference between the ETF and its underlying index. And that difference should be as small as possible. And if it tracks the benchmark perfectly, you should expect the performance of the index minus the management fee of the fund. If you move over to the tracking error, that's that volatility of the tracking difference. A trick question that I always ask is, what's more important? And the answer is, they're both important. Perhaps you could argue if you're a long-term investor, tracking difference is more important. If you're short-term, you don't want that volatility to be too high if you're just doing a tactical trade in and out within a couple of weeks or months. Exposure, what's inside your ETF? Very important to understand if it's a regional or global ETF, what's the country makeup, what's the sector makeup, how much financials versus IT technology. And again, most ETF providers will provide you this information on the internet. You can go and look at the holdings, and usually you get a little pie chart and you can see very clearly what you are buying, because this is very important. You might be buying into small caps when you wanted to buy into large caps. And remember, there's a small cap premium, so potentially that changes the way that the index will perform, depending on what's happening in the economic cycle, or if small companies are being favored at the moment, et cetera, et cetera. So we have to think about what's in the fund, but not only think about what's in the fund, but think about how is the index calculated, how is the index monitored, and that's the part of the index methodology. So really understanding how we are screening and how that ongoing screening and calculation is done, again, very important. And does it match up with not just what you want to do, but does it match up with the rest of your portfolio as well? So a quick example just to make the point here, we're looking at US exposure. Again, there are many different indices that you can invest in. We've got the S&P 500, we've got a mid-cap and a small-cap fund. The Russell 2000, as some of you might know, spans across mid and small-cap. And guess what? It's a little bit older data, but just to make the point, in 2017 for the full year, you can see S&P 500 outperformed. So it was definitely a year for the large-cap stocks. And you can see the small caps came in last. So again, just making sure that you know what you're buying. So whether you buy the Russell or the S&P, it makes a difference. Just be sure to check. Structure. So generally we speak about physical ETFs and synthetic ETFs, or what we like to call as derivative-based, swap-based ETFs. If you are looking at the physical ETFs, which is really where the majority of ETFs play, you have two avenues you can go down. One is full replication that you typically find in the equity space, and optimization is what you find in less liquid markets. So we've got emerging market equity as an example, but also in the bond market. And what we try and do in the table, in the graph here, you see on the x-axis, you've got the number of issues, so the constituents or components, versus the tracking error, basis points. And we want to find that optimal point where we add as many securities as we think necessary to minimize that tracking error. And that takes great portfolio management to do. Hence, again, that's where the value of the manager comes into play. If we go to the derivative-based ETFs, the synthetic ones, we've got a little table here, and I think you can look at that at your leisure. But really, the big difference here is the counterparty and credit risk that you take. In a physical ETF, you don't have that. If you're investing into a synthetic ETF, you have counterparty risk. If that issuing entity of the exchange traded note would default, you're linked to that recovery rate of that issuer, and it's not really what's inside the fund, whereas in a physical ETF, the assets are ring-fenced, you own them. And also, you know, when you look at the sort of the benefits, again, physical, it's quite simple. It's transparent, it's low cost, so you can see on a daily basis what you're getting. In a synthetic ETF, and they definitely have their space in the market, you're getting access to potentially restricted markets. China used to be a restricted market, still kind of is, but it's opening up. You've got sometimes physical holdings are not practical if we think of the commodity space, so there's a lot of commodity ETFs that are synthetically replicated, or just complex strategies, building in leverage, inverse ETFs, they're all synthetic. So again, do your homework, make sure you understand these products, and a lot gets written about them. I think, depending on what you want to do, you can look at both, but be sure you understand the risks in the product. Liquidity, and we could do another webinar and spend an hour on this. This is my favorite slide, but I've also been told it's a complicated slide. So you see a triangle. I like to think of this triangle as an iceberg. So when you think of ETF liquidity, what we typically get as an answer is people look at the exchange volumes and they say, that's it, that's the ETF's liquidity. And that's not the case, because again, as what I said in the beginning, the ETF is built using underlying securities. So the point is that you have to look at the liquidity of the underlying market, what we call here the primary market. So if it's, Australian shares or US shares, look at those markets. That is the depth of your market. And if we need to create more units, if a big order comes in, we can do that at a very low cost. If it's emerging market bonds, we also have to go and buy the bonds if the exchange liquidity dries up, and then you pay the full bid offer. So the advantage of a large ETF is that the green box, the on-screen liquidity, will tend to grow. And what we see with a lot of the large international ETFs is that there's more trading happening in that green space, the exchange trading, rather than the primary market where we're creating and reducing the amount of units of the ETF. So again, that green area on screen is a nice to have, but if it disappears, you've always got that underlying market. But typically, rule of thumb, the bigger the ETF, the better that green liquidity is on screen. Finally, cost, really important. Total cost of ownership. Think of it as really a multi-component calculation that you should do. And you don't need to overcomplicate it, but it really is about the journey of when you invest. You've got, when you purchase ETF, you have trading spreads, you have broker commissions, your holding cost, and that's not just your management fee. And then again, when you sell your ETF, again, your trading spreads, your broker commissions, but that middle piece has more to it than just the management fees. So there's rebalancing costs, there's securities lending, it could be taxes, etc. if the fund is not fully invested, there could be a cash drag if the market rallies and you have a big cash portion. So again, this comes down to just looking at that tracking difference, which will incorporate all of those points in the cost of holding. And you can kind of think of it as buying a car where you've got your purchase price, and I would say that's kind of like your sticker price, that's your management fee, that's the thing that's very obvious. And you have your maintenance costs. So you think of the journey with an ETF, you buy and you sell, and you need to, that's your fuel, how much do you need, and that's your sort of variable cost there. At the end of the day, you figure out what that total cost is for the full journey. If it's a illiquid ETF, you might have high trading costs. If it's and you know the management fee might not be the main component that you need to focus on. So it really depends. So I think look at the management fee, absolutely, but also look at the other elements that really comprise as part of this total cost of ownership. So to just recap what we've said. And, we've sped through it pretty quickly, but I think, again, think of this as a framework to arm you to just break down those thousands of products. If you're looking at the Australian range, it's more like 200, but to think of the manager. And the manager plays a role really when it comes down to that portfolio management, making sure that tracking difference and tracking error is really minimal. Especially if you start looking at the more complex markets. But again, making sure you understand what's inside your fund, because you will have many indices that look and feel the same, but they will perform differently depending on what's inside. Structure, I think for the most part, people understand. Physical ETFs are really the majority of the market. They're very safe, they're very transparent, and the good news for the investors is that there is a lot of price competition and compression going on. So that ability to buy these beta exposures has really dropped over the last 10 years. Again, you can get many exposures for sub 10 basis points. Liquidity, really one of the big things for ETFs, and multifaceted. So what, typically the liquidity that from a mutual fund, an ETF has that, but it has more. And the bigger the fund is, the more of that additional liquidity it has. But remember, don't only focus on that on-screen liquidity. That's only telling you part of the story. It's only the tip of that iceberg when it comes to the liquidity. And finally, cost. Cost is really your cost of the whole journey. Don't just look at the management fee. There are many other parts of cost. Primarily, the trading cost really sticks out as one of those costs that can actually shift the way that you look at an ETF. But again, the tracking difference will comprise everything that's going on inside of the fund as well. So those are the 5 things. There are more. And, we could speak about each of these categories in detail. So I think we have a little bit of time left and we'll take some questions. And I believe that's the end of my presentation. So thank you for listening.
Great. Thank you, Christian. So we do have a couple of questions that have come through from people who are watching at the moment. Just a quick one here. How are investors outside of Australia using ETFs?
Sure, and I think it depends what type of investors we think about. I think at the end of the day, what's really happened in the last 5 to 10 years is that globally speaking, we now have pretty much any investor type is a potential ETF investor. There are no more categories that just categorically say we don't invest in ETFs. There's a utility for everybody really, whether it's a retail client, a private bank, an asset manager that uses it for tactical trades and liquidity, or even super funds that, either they can use passive exposures, primarily still index funds, but also starting to look at ETFs because as the cost has come down, they can use it for long-term strategic exposures, but also certainly to manage, their dynamic tactical asset allocation. So I think, the reality is that we see a whole broad range of reasons, whether it's strategic long-term holdings, tactical trading, but also transition management. If you typically invest into active funds, let's say you're unhappy with the performance of a manager, you'd like to get out and do your due diligence on a new manager, instead of going back into cash and taking huge market risk by not being invested, you can just fill that void with an ETF. And because typically, or I'll say some of these exposures are liquid, you can transition in at a very low cost, stay invested, and then as soon as you've done your homework and would like to move on to another active manager, you can do so. So that's another area that we see as very popular. But just really liquidity, is having a liquidity sleeve, maybe saying, okay, well, I'll build the portfolio myself, I'll just do stocks and bonds, and then I'll use the ETF because it's liquid and I can get in and out of, let's say, high yield, for example, at a very low cost, rather than struggling to buy and sell the bonds and find the bonds that I want as that market has become constrained.
Great, thank you. Another question here. How have ETFs held up structurally in post-market environment?
Yeah, it's a great question. And again, that's a topic we could spend a lot of time speaking about. I think so far, ETFs have really done great and shown that they're very robust. If we look back, and we have a lot of data on this, it's something we've been researching for a long time. If you look at really the market stresses, whether it's GFC, the US's AAA downgrade, the oil crisis that we had a few years ago, the mini high yield crisis that we had, and even just coming into the end of last year with that heightened liquidity, ETFs have held up. And what we typically see is with liquid ETFs, investors actually gravitate to them, and we see more trading volume rather than less, and we see more volume get handled by the exchange. And that's good for the ecosystem because it means that there's less downward selling pressure. Because if all of that trading was going through physical holdings, let's say a stock or a bond or an index fund that has no exchange tradability, all of that selling has to go through the market. With an ETF, you're finding the other side of the trade on the exchange, and there's no need to sell the underlying constituents. So we find that it acts as a buffer in market stress. Now, naturally, when I talk about the superior liquidity, I do speak about the large liquid ETFs. And of the 6,000, I think you can narrow that list down to probably 100, which are the mega ETFs that offer that kind of superior liquidity. But we haven't really seen, at least in the physical space, we haven't seen any structural problems. As has been, written about in the media, there were some problems around some of these volatility VIX-related ETFs. Again, I think most investors don't actually understand what they buy. So that's important to understand. How does the product react in any given market? And I think that's the challenge with those products because they are less transparent.
Absolutely. One final question. We have recently seen a lot of active ETFs coming into the market. What is BlackRock's approach to these products?
Yeah, sure. So we currently don't issue active ETFs in Australia. We do in other markets, in Canada and the United States. So it's not something that we totally exclude or don't plan to do. It's just at the moment we haven't got any plans here in Australia. The products we offer are very vanilla beta products, just your one-for-one exposure to the market, no leverage, nothing, very simple, but really think of them as simple building blocks, low-cost building blocks to build portfolios. And I think, that's the direction we'll continue here. But as a firm, we don't exclude it, and we're always looking at the market and, adapt as necessary.
Great. Thanks, Christian. I think we've come to the end of the webinar. Thank you again for presenting, and thank you to everyone who dialed in. We'll be sharing a recording of the webinar on our website and in our February @Hub newsletter, so keep a lookout for that. If you'd like to get in contact with Christian or anyone at BlackRock, please speak with your BDM or call our support team and they will put you in touch. Thank you again and have a lovely day, everyone.